You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and we are rejoined this week by Conor at Occasio Capital, probably better known by his Twitter handle at Investment Talk with 2Ks. So Conor, welcome back to the show.
Hi Sam, thanks for having me back.
You're the first person to come back, actually, apart from me and John.
Oh, really?
So you can read into that what you will. Whereas last time Conor came on, it was more of an interview and really getting behind what made him tick as an investor. I mean, that was only 2 months ago, so I wouldn't say it's really in any way dated. So if you do like this or you want to find out a bit more about Conor first, I'd say go back to that episode. I think it was episode 31 off the top of my head. So this time we're just going to jump straight into some stocks and some questions that you've all asked on Twitter. So number one on the list, do you want to talk about Kura Sushi? Is that how you pronounce it?
Yeah, so it's Kura Sushi. And for anyone that doesn't know, every month I'll typically dive into a new business and kind of provide some kind of, really lengthy piece on that, diving into all the different aspects of the business and management and that kind of thing. So this was just part of that. And this was the fourth edition this month. And previously I've been looking at kind of well-known companies, kind of in the mid-cap range, recently covered Redfin, Etsy and Pinterest, but this time I wanted to do something a bit different. So I decided to go down the route of a kind of small cap, maybe lesser known name. And I stumbled across Kura Sushi, which was something that I'd already been looking at for a few months before, but I thought it'd make for an interesting piece. And this is free on my Twitter and stuff. Everyone can go read that. But basically, I stumbled across this kind of small franchise based in the United States, which is actually a subsidiary of a larger Japanese parent known as Kura Corporation. They have about 450 of these kind of rotating plate sushi restaurants. And Sam, if you're based in the UK, you've probably heard of Yo Sushi before.
I've never actually been to one though.
Have you not? It's interesting. It used to be really good, but I feel like the quality's kind of slipped a little bit recently. But yes, Yo Sushi's big in Europe. They have about 100 stores across Europe. They don't really have any penetration in the United States. That concept is a bit more novel. And this was a concept that was kind of made back in the 1950s. I forget the name, but it was a Japanese guy, and he was looking at kind of beer bottling plants and kind of related that to the sushi industry, where it typically takes quite a long time to kind of compose all these food items and then sell them. And kind of the turnover that you could get on customers was quite low because of that. So he kind of wanted to automate that and came up with this system whereby you would pre-make sushi all fresh, free from preservatives, and then send it out on kind of like a rotating belt that goes around the restaurant. People can just pick it off and get billed per plate. And what that did was it basically allowed restaurants to turn over customers faster. And it took the kind of sushi industry from a sit-down kind of meal to something that was more similar to like a McDonald's or a Starbucks, where you can come in, spend 20 minutes and leave. And it also reduced the price of sushi considerably so that the lower classes could enjoy the food as well. So that kind of took off across Japan from the 50s. And then towards the 80s and 90s, it started to pick up in the United States as well. And what we actually saw was a lot of larger Japanese companies that had a lot of presence in Japan come over to the United States and kind of set up subsidiaries and, test out the demand over here. So I think from the 80s to the 90s, the number of sushi restaurants in the US actually quadrupled. So obviously they started coming in. And Kura Sushi didn't come in around that time, but the Japanese parent has been around since the late 70s and still has the same president on top of the company today. And this company set up Kura Sushi US in 2008, started building out a few stores very slowly, I might add. I think they had one store in 2008. Within 5 years, it was maybe 8 stores. And they were growing at maybe 3 stores a year from some point after that. And then in 2019, they decided to go public. They raised just shy of $40 million. And then they started kind of scaling out the production there. And what I found to be the case with Kura Sushi, who currently have about 32 stores, and I'm saying in about maybe 3 to 4 years, they should have just shy of 60. So doubling there. It looked more so the case where this was maybe a great business, but the price currently doesn't really reflect something that you'd want to jump into with 2 feet out in front of you. Trades at about $330 million. And when you consider that the last 2 quarters have had about $9 million in revenue, it doesn't, it seems like quite a stretch to kind of buy in at that price. But the conclusions that I had on the positive end would be that it looks like the kind of trough in earnings is behind us. They report their fiscal year kind of one step ahead of the usual year. So in Q3 last year, their sales fell from about 20 million per quarter down to about 3, 4, 5, somewhere around there in their Q3. And then it kind of went to 9 and then 9 again. And then for this coming quarter, they report in a couple of weeks. I'm expecting that to be in the kind of mid double digit range again. One of the interesting things that I found about the Kura Sushi kind of franchise is that it costs them around $1.8 to $2 million to set up a store in the US. And within about 18 months, one of those stores is generating about $3.5 million in sales or average unit volumes, which is basically an aggregation of all their stores that have been open for 18 months. And they take an average of the sales price, the sales there. So that's quite a favorable payback period. Within less than 2 years, you're recouping all your kind of revenues there that you spent on building out the store pre-COVID. And it's really a kind of pre-COVID versus post-COVID story here, because pre-COVID, the Kura franchise was actually profitable. They had I wouldn't say attractive gross margin, but there's definitely a lot of kind of capacity for expansion there. They had positive operating margin. They were positive on the bottom line as well. And obviously COVID happened and crushed all that. But I'm fully expecting next year that'll kind of, revert back to normal. They have an efficient kind of cash conversion cycle whereby, because of the nature of the product that they're selling, they'll buy sushi, which is mainly what they sell. They also sell beverages and stuff like that as well. But they'll take their sushi, the kind of raw ingredients, and they'll typically flip that once every 4 days when they buy on credit from their vendors, and they receive payments, on premise, because whoever's paying with a debit or a credit card will typically, the cash will be collected on premise or within a few days if it's with a credit card. And with the nature of their kind of vendor relationships, they don't have to pay them back for 30 days. So what you're actually seeing, similar to something like Amazon would do, you've got a negative cash conversion cycle whereby they're able to purchase these goods on credit, fashion them into sushi items, sell them, collect the payments on those, all before they actually have to pay their vendors back, which in a non kind of COVID environment is really efficient. They do seem to have considerable wiggle room for kind of gross margin expansion and operating margin expansion there as well. Like I noted, the low cost of the sushi is like $3 a plate, which is crazy to me being from the UK, because sushi is quite a premium product here. Even if you go to somewhere where it's a bit more commoditized, like a Yo Sushi, it's still quite an expensive bill, even if you're just going for kind of a midday lunch. But somewhere like Kura Sushi, it's it's $3 a plate. It's targeted at kind of mass audience. Anyone can go, and you don't really have to spend a lot to have a good meal. So they kind of have pricing power there, where typically if they're increasing the price of the, if we call it a price per plate of $3, a 10% increase there would only be 30 cents. It's not really noticeable to a consumer. So it's something that they can, pull out on the back end of there. They typically only raise prices to kind of, meet inflation, but management recently said that they are looking at that as a lever to kind of drive that gross operating margin. Pre-COVID, that was about 15%. But then if you look at the parent corporation, who obviously have far larger economies of scale, their gross margin is typically upwards of about 55%. So, 15 to 55, obviously there's differences in the way that works between the US and Japan, but there's obviously a lot of expansion there. And that would obviously help the operating margin as well. The store concept itself is quite interesting. It's quite novel when you go into one of these stores. I'm not based in the US, so I don't actually know, but I have watched a lot of videos and spoken to a lot of people that have went there. And I managed to speak to one person that actually manages a Kura Sushi as well. But it's quite a novel concept. You go in and you see all these kind of sushi plates whizzing around. You sit down at a little booth, and on the bottom belt, there's just stuff spinning around constantly, and you can just pick it up whenever you want. And on the top belt, there's a little POS ordering system whereby you can order stuff and it comes to you automatically on that top belt, which was another area for operating margin expansion, because Kura don't really spend a lot on front of house staff because it's all automated through all the IP that they have. So that's quite novel. They also kind of gametize the sushi aspect as well, which reminded me of kind of, when you were younger and you'd go to McDonald's, and, half the reason you want to go to McDonald's was because of the Happy Meal, similar with Burger King. I don't know if Burger King did that in the UK. I grew up in Germany, but they definitely had Happy Meals at Burger King in Germany when I was young. And that was one of the reasons you'd go. And at Kura Sushi, when you eat 15 plates, you push them into this kind of chute next to the table, and using QR codes, it scans all of those, mocks up your bill. And when you've had 15 plates, there's a little machine next to your table, and it pops out like a little Kinder Egg kind of toy. And, that's all fun for the kids and the family and stuff, or even just kind of the older adult that enjoys those kind of trinkets. So that was quite interesting. And obviously they just have, quite a long runway for reinvestment. They have that Japanese parent corporation, and they get favorable debt from them, as well as kind of all the IP and some shared resources and stuff. That's obviously kind of something you have to consider on the bearish side as well. They're quite beholden to this company, but they had a revolving credit kind of facility, opened at 20 million during COVID. They raised it to 45 million about 6 months later, but they're getting that 1.1%. And for a small cap, this kind of an emerging growth company, they'd struggled to get that, favorable rate borrowing in the third party markets for debt. So that's something to consider as well. And lastly, I'm quite bullish on their ability to continue to, open up new stores. Right now, about half of them are based in California. They have a few in Texas, and then they've got one dotted around kind of a few other states like Washington and then New York as well. But I'm fully expecting the store count to double within maybe 3 or 4 years. And on the bearish side, as I said, there's not really a lot of room for kind of faults there. If you're buying them at this current valuation, you're kind of really pinning everything on them, A, recovering, and then B, kind of following through with that kind of store expansion. So it's probably a more appropriate price to jump in. So it's likely a good business, but trading at a questionable price. And I feel like maybe it's just late cycle kind of stuff talking, but there's always this emphasis on, we have to buy a good business. It's always an afterthought to be like, is this actually a good price? Some people just buy anything at any price. And again, that might just be late cycle stuff, because if you looked over the last 5 to 6 years, maybe in the last 8 years, that's worked. You could just buy something at a ridiculous valuation, look back 3 or 5 years and, job well done. But that doesn't always work over the long term. Some other considerations on the bearish side, I think they're kind of, they've got all this great IP and they have a bunch of patents. I don't want to talk your ears off, but they have a great few patents in there that actually kind of give them a slight competitive advantage in terms of cost leadership position. But all of this stuff is owned by the Japanese parent corporation, everything from kind of naming rights to their IP and a lot of their resources and stuff, that's not owned directly by them, which is the kind of nature of being a subsidiary. But that's something you always have to consider if they ever want to kind of get engaged in the M&A markets. That has to go through the Japanese parent as well. They couldn't just go out and acquire another company or be acquired with the Japanese parent having about 80% of the voting rights. They have the last say on that. So you're really kind of beholden to that. Kura are also an emerging growth company, which for those of you who don't know, they don't have to report as much as a regular company. Emerging growth companies, off the top of my head, I think it's $1 billion in the last year or so after becoming a public corporation. And for the next 5 years post-IPO, there's certain reporting standards that they don't really have to adhere to. So that puts into question the reporting quality, which then puts into question the earnings quality, because if you don't have good reporting quality, then you can't reasonably say that the earnings quality is, solid. As well as that, they have a really big kind of concentration of suppliers. Right now, about 86% of their primary supplies come from 2 Japanese subsidiary companies, and that's increased from about 44% over the last 3 or 4 years. So any kind of relationship breakdown with one of those 2 companies, would be kind of harsh on them. And then lastly, I'd probably say the executive team is an interesting one. It's quite small, and I don't follow smaller caps in the day-to-day investing stuff that I'm doing. So I'm not super familiar if this is normal or not, but the small management team only really has about 3 executive people in it, and they cover the majority of the roles. Jimmy Uba, as he's called in the West. He does have a Japanese name. He's been with the parent company since I think 2000, and then joined the USA one in 2008. But he even doesn't have such a great experience of running a public entity, only since 2019 when they went public. They did bring in an American CFO just at the end of 2020, but he's the only domestic member of the executive suite in there, and a lot of their kind of upper level managers are actually borrowed from the Japanese parent corporation, so they'll send over employees to the US one. A lot of them don't actually have written down employment contracts with the US subsidiaries, so they can kind of be pulled at any point. So that's something to consider as well. But I think that's my main takeaways. I actually do own some disclosure. It's a small amount, kind of like a starter position, tracking position. But yeah, it was an interesting one. It was exciting to kind of dig into, and it led me down a lot of rabbit holes for other similar setups in Asia. So I'm definitely going to be taking a look at those over the next few months.
You said that you weren't sure on the valuation. You thought it was a good business, but you weren't sure on the price.
Yeah.
But you've taken a position anyway.
Yeah.
Why is that just a tracking position then?
So it's a bit of everything. With smaller cap names, there's a few kind of adages that I go by there, and one of them is, I think Brian Ferrari said it as well, if it's below $1 billion and you feel like it could 5x within a certain amount of period, then any quote unquote valuation, whether you're looking at kind of like a multiple, or you're just basing that off kind of existing assets, I'm not super price sensitive in that case. If Kura could be a $5 billion company and it's currently a $300 million company, then I'm less price sensitive there. I personally think it might be somewhere between 1.5 to 2 billion, maybe in the next 3 or 4 years, just based on their kind of store count growth. And then if they maintain that average unit volume, which is about 3.5 million per store, if all this stuff kind of recovers and they meet their store count growth target, I think that they could be earning revenues, enough so that if you slap a 3 times sales multiple on it, they could be a 1.5 to $2 billion company, which is what they traded at pre-COVID. Now it's like 10 to 12, but that's warped obviously because the sales have fallen due to COVID and stuff like that. But I think when you go from a $325 million company up to a $2 billion company in the space of 4 years, that's still, quite attractive upside for me. So it's partially that I'm not super price sensitive to the valuation. The reason I wrote that is, because people read what I write, and as much as you don't want them to, they might get the idea that they maybe want to own this, but it's just, kind of just to say, like the way I invest is totally different. I'm not price sensitive when it's kind of a lower valuation. If I feel like it can, multiply a few times over the next 3 or 4 years, I'm less price sensitive with that respect. And then on the other side of that, it's just, if I own something, I'm much more inclined to follow it. I know that's not the most efficient way of doing things, and a lot of people would disagree with that, but I find even if I have a small 1% position, I've done the majority of the work, then I'm more inclined to follow it each quarter and, put the work in there. If it's sliced in half tomorrow, I'd probably increase it to, a 3% position.
Could talk a bit about how you actually, get a feel for the business, because obviously it's a Japanese parent company that trades in the US. So you're never going to actually, or you've not been able to go to one. So you mentioned that you've been watching YouTube videos where there's like bloggers like reviewing it and like filming the whole meal. Yeah. And then it also links to Match, which we're going to talk about later. But I know from an interview you did on Chit Chat Money that you were on there asking people about their experiences on Match as well. So I was just wondering if you could talk about like why that's so useful and helpful as part of your investing process.
Yeah, so you'll probably know Philip Fisher's, had that whole idea behind Scuttlebottom, where, you're looking for stuff that's not in the financial statements or kind of on investor relations slide decks or anything like that, or in earnings calls. So one of the things that I was faced with was we have the Japanese parent. It's the subsidiary that trades in the US, and it's the subsidiary that I own. The Japanese parent does trade on the Tokyo Stock Exchange. I think it's maybe valued 1.5 billion, 1.2 billion, somewhere around that. I can't remember. So I own a subsidiary and they're based in the US, and obviously I can't go see them. It'd be an expensive bit of due diligence to go fly over and check one out. So I reached out to as many people as I could on Twitter that I know are based in California. That's where they have most of the stores, as well as just generally. I spoke to one gentleman that was in New York and actually very kindly went to try it because he saw that I mentioned it and just said that he was going to go and he'd let me know how it went.
What did he think?
He said it was really good. And one of the common themes, which I'm about to discuss in a moment, was interesting that he said, just before I get to that, the last place I looked was on Facebook. I do advertising on Facebook for the newsletter. And I noticed that a manager at Kura Sushi read and liked the article that I put out. So I just messaged him on Facebook Messenger and just said, do you have a minute to kind of chat? So I learned a lot from him as well. And the biggest commonality that I found when I was speaking to customers and then this one manager, even on some of the YouTube videos as well, but I'll get to that in a moment, was that the places are always packed. It's like, if you want to go, you have to wait for about an hour or 2 hours. They're always packed. That's the first thing that most people say. It was great, but I had to wait for an hour or 2 hours. They do kind of combat this if you have the Kura Sushi app. I think there's only about 100,000 people in the US that have it right now, but if you have the Kura Sushi app, you can check which store you're going to. You can check the availability of tables and kind of waiting times there. So you could, in theory, tell them I want to come in an hour. They'll be like, well, you have to wait an hour and a half, and then you just come, whenever you want to go. So that's one way of combating that. And then obviously the best way of combating that is just to purely build out more stores. And that kind of, when you're thinking about the amount of resources they have and it's quite limited, if you're packed in California and you're so busy there and all your stores have 2-hour waiting lines, do you keep reinvesting in that state and kind of increase the exposure there? Or do you kind of build out into new states? And then you have the same problem if you go to where they're not based. If you go to like Wyoming or something and set up a store and it's the first one there and it becomes really popular, then you've got the same problem, but now you're in a different state. So that's something that's interesting to watch because they have a focus on kind of existing markets and then what they call white space. They'll typically shove a store in one state, let it ruminate for a bit, and then if there's demand, they'll keep building it out. But back to the kind of thing that I was talking about, when I was talking to customers, the first thing they always said was, it's super busy, the waiting lines are so long, which to me is a good thing because, there's people that want to get in there. And the stores aren't terribly small and the turnover is pretty high, faster than a typical restaurant, maybe slower than a McDonald's. So I doubt it's the service. So that's a good thing. And the second thing was the quality of the food and the price was typically good. Everyone said that it might not be the best sushi they've ever had. A few people said that, no joke, if you're paying $3 for a plate, but they said it was good quality. The service was easy. They didn't really have to interact with too many people. It all came to the table. It was fun. It was fresh. It was tasty, all that kind of stuff. I didn't really hear any negative reviews about the service or the quality of the food. And I've maybe spoke to about 9 customers, and then just for that one manager there, the waiting lines was obviously the biggest thing. And then YouTube as well was just another source because, I can't physically go there, and the number of vloggers there are today, there was bound to be some people. And I found a video of a store from each state that they're currently in, which was good. I shared a lot of those in the newsletter just so people can experience it for themselves. But, it looks fun. It's something I'll go to if they were based in the UK. I love sushi though, so I'm biased. I probably eat it maybe once or twice a week. So that's how you get a feel for the store. And then also, which might be a bit of cognitive bias as well, I've spent a lot of time studying Starbucks as an interested, just generally interested in kind of how franchises and brands grow. But then also on the other side, I own a position in Starbucks and have done for a number of years. And part of the early process for me, understanding that company was, reading Howard Schultz's books and then also reading through back issues of their annual reports. And if you go back to kind of the mid-90s, Starbucks actually have old-fashioned annual reports where they actually split up the financial statements and the commentary, and they're all kind of this ugly, graphic, brown-looking stuff. And the early innings of the Starbucks franchise was, I wouldn't say similar at all, because even back in 1995, Starbucks had hundreds of stores in the US, and they were, but there was a point in Starbucks history when kind of their size caught up with their expansion, and they started, pumping out 400 stores in like 1995. The following year it was 600. After that it was 800. And then I think in the year 2000, they did their first year of opening 1,000 new stores. And obviously that's like the compounding effect as well, and it kind of meets the same goals as what Starbucks were doing back then and what Kura Sushi want to do. The best way to market a restaurant is purely just to have more space in the market. And if Starbucks are opening 1,000 stores in the US, it's 1,000 more kind of end points for consumers to engage with the brand, feel the products and all that kind of stuff, tell their friends. But that's vastly different because Kura Sushi only have 32 stores and they're giving guidance for maybe 300 stores nationwide as kind of the target, which is 10x what they have right now. And that's nowhere near. I think Starbucks have 16 to 18,000 stores in the US or the Americas segment alone. I don't think it's ever going to be like as big as Starbucks, but do I think it's going to be a $300 million company forever? No, I don't. So that's kind of part of the thesis there.
They don't franchise, do they, currently?
Sadly not. And that's something I spoke about as well. Ideally, they wouldn't be owned by this Japanese parent because corporate kind of, conduct in Japan is way different than it is in the US. So I don't think Kura are going to be going on any mass acquisitions. They can't do that. And they don't do a franchise model. They're all kind of company operated. It wouldn't just... But I think if they wanted to scale rapidly, they would just, they would license out all of the IP and the kind of the rights and, open up loads of franchises that could grow a lot faster. But then I don't know if I can see that happening because I don't think they did that with the Japanese parent. Or they also have a subsidiary in Taiwan as well. And I don't think they're doing that there. But I would love to see them do that in the US. Obviously, that'd be like an embedded option there, but I don't see it happening.
So we'll move on to our next company. So Etsy, it's a company that we're both familiar with. We've already covered it a couple of times on the show, so I don't think there's any need to go into what the business does. And if you're not familiar with Etsy, you can just go back and listen to a previous episode where we've covered it. What I really wanted to talk about is you did the deep dive a couple of months ago, and since you did that deep dive, they've announced the acquisitions of Depop and LO7. I don't know if it's ELO7 maybe instead. I've not actually looked at it. Is it ELO7 then? What do you think of those acquisitions? And, well, do you like them or do you dislike them?
The Depop acquisition, I don't think I like either one more than the other. I like them both on the aggregate. I would now kind of wish that Etsy, stops with the M&A and just kind of let these two acquisitions settle. And then so we can actually see how they influence the kind of the fundamentals of the business over the next year. If they added something else in the next 6 months, it's just going to be quite warped for the next 18 months. So I like the acquisitions. The Depop one, I didn't really understand at first the price. I think it was about 1.6 billion. And just based on the size of the product, I didn't really understand that. As time goes on, they might, I'm just trusting the management, see more value in that. I understand the case for Depop. Etsy did have an apparel segment. It was one of the bigger ones, but wasn't, the most influential one. And this kind of segues into that with Depop directly.
Have you used Depop?
I haven't. My partner has, and she has, for a number of years, kind of passively. So I have experience of it, and I knew of it straight away when they said. And interestingly, and this isn't Mystic Ball or anything like, I'm not trying to pat myself in the back, but I remember talking to my partner weeks before this acquisition was announced, and just said it would actually be funny if Etsy bought someone like Depop. And I remember I was sat in Starbucks doing some work when the announcement was made, and I stayed there and listened to the earnings, the M&A call, and I just thought it was funny.
It's funny as well. So I've never really used Depop. My brother's a big user of it because he's about 5 years younger than me. So I think technically I'm at the back end of millennials.
Yeah,
he's at the front end of like Gen Z, and he uses it like a lot. So he was around like a year ago. He was staying at mine for a couple of months, and he was using it a huge amount. So I actually really liked it. It was one of the things where I wasn't using it myself, but I got it quite quickly. So I had a look to actually see if it was public, because it was the sort of business that I'd be interested in. So although I didn't predict it quite as well as you, I did end up owning it anyway.
Yeah, it's an interesting one because it's like, for anyone that's not used it before, it's kind of like an Instagram feed. It looks a bit like Instagram, but all your photos are really just like pieces of clothing that you own in theory, and you're selling them. Someone direct messages you, and the first thing they always say is, can you do it for cheaper? That's the kind of comments I've got from speaking to people that use it. I was actually, we talked about this before we started recording, but the place where I live just had opened a big 5-story mall, and I was outside of that mall a few weeks ago and just overheard some girls talking about it. And this girl was a seller on Depop, so I asked her a few questions about it just randomly to get more insight. But as I said, my partner's been using it for a while, so I was quite familiar with it. The size, isn't huge. I think 2 million sellers, 4 million buyers, and then quite a high proportion of those sellers are also buyers as well, which makes sense. It's kind of just like a secondhand market. I don't really understand the moat there. There's a lot of competitors in the space, and it looks so much like Instagram that I don't, Instagram kind of growing into that commerce segment as well. I don't see why they could have something similar to Depop in the future. And obviously with Instagram, there's a far larger user base there. But I do like this idea that kind of management is saying this house of brands, they picked up Depop, and then they had Etsy, they had Reverb, and they had Depop. And then, only a month later, they picked up Elo7, and then there's 4. And to your original question, Elo7, the acquisition I quite liked. It wasn't too much. It was just over 200 million. Seems like they're saturated with buyers. I don't think the seller market or the seller side is so mature there, because they have, I think, 65,000 sellers and then just shy of 2 million buyers. So it's like 33 times more buyers than they have sellers. Whereas on Etsy, it's about 20 times more. And then on Depop, it's 2 times more.
I'm just thinking out loud here, but I know they are already active in Brazil, and I know they've said they're going to keep it separate. But it wouldn't be that difficult to have it so that if you list something on Etsy Brazil, you get the option to automatically list it on Elo7, which would probably make a lot of sense. But that's just me thinking out loud.
Yeah, I mean, that could be a good idea, because similar to if you sell on Etsy, you could just chuck that on Pinterest as well. I know those two don't have any kind of relationship there, like mutual or whatever. But yeah, that could be something that'd be good, I think, for sure. I think it makes sense, the Elo7 deal, because although Etsy they are in South America, you're just acquiring someone that's already got a presence there, mainly women that use it. And I think the runways for reinvestment, although they might not be as quote unquote stable or safe or whatever in South America, the runways are probably a lot longer. I think, commerce penetration and payments as well, especially if you look at people like Stoneco and kind of Mercado Libre, who are doing both, there's a lot of investment going in there, and the overall kind of penetration of commerce across the country and the whole of South America as a whole is a lot less than it is in the US. So whilst the US has, the next 10, 15 years ahead of it, probably going to continue to compound, in South America, it's likely a lot longer, and it might, be a lot more bumpy, but I mean, it makes sense to me.
Yeah, I like both the acquisitions. I probably do prefer Elo7. I think it just makes a lot more sense. I do really like Depop as well. I really like the business, but they've paid a lot for it, and it's just one with Depop where I look at it and it's similar to you. I look at it and I think it's a really great business, but I struggle to visualize how large they can be. I'm quite happy to trust the management that they obviously think it can be a lot larger. Whereas with Elo7, when you look at the price they paid and all the factors going in their favor in Latin America, that to me, that one just looked like, well, that's a really good buy, especially when it's only, 3 months cash flow they actually paid for it.
I think one last point I'd make on that as well, and if you consider if you look back to when Facebook bought Instagram for $1 billion, back in 2012, if I'm not mistaken there, that was a crazy price to pay. It was a small kind of app with a small batch of people working on it, and Zuckerberg kind of noticed that they need to kind of lean more into the mobile space, because there was this whole debate about whether Facebook could convert from desktop to mobile. So they started buying WhatsApp and Instagram and all this kind of stuff. But one of the things that you can't kind of underappreciate is that kind of network effect, where when you've got 1 million people, 2 million, 5 million, 10 million, as that keeps increasing and there's more people that on the app, and the network effects kind of start powering ahead. When you've got past some kind of pivot point there, that's hard to stop. On in hindsight, and I know this is in hindsight, so I don't sound smart at all, but in hindsight, that was a good deal, because Mark Zuckerberg bought Instagram at this kind of inflection point, and he could obviously see that Instagram was going to become huge and is based on mobile, so he wanted a part of that for the Facebook conglomerate, or it would later become a conglomerate. And you even see that now, they went from desktop, they went from mobile, and then the next threat is probably going to be what comes next after that. If it's VR and AR, they've got Oculus there to kind of shield themselves from that. But, not to get too far away from the point, when you look at Depop, does it look like something that a billion people are going to start using in, X number of years? Like Instagram might have looked at like back then. Depop's been around for a while, and, there's only 4 million buyers on it. So yeah, it's hard. And I'd probably be saying the same thing when I was looking at Instagram in 2012. I wasn't investing then, but, so it's really hard to kind of gauge the network effects on Depop. Are they strong there? Is it, worth paying the price? If, they could spend 2 billion and, make something similar, I really don't know. So the Depop deal is kind of like TBC for me. I understand it. I like it. I don't know how well it's going to do. The ELO 7 one was a lot better, I think. But, I'm not going to rush out and sell. I actually bought quite a bit more since those two deals were announced.
So that's quite an interesting point, actually, because Etsy's now, is it a 10% position for you?
Yeah.
How do you feel about that then? I mean, obviously, you've just bought more. So that's obviously quite indicative.
Yeah. So, and you have to frame this in the kind of mind where it's like, I'm 25, so I have still, multiple decades of earnings power ahead of me where I'm going to continue putting cash flow into my own personal account. But for right now, in this moment, for the next 12 months, Etsy's a position that I want to have a larger weight in, similar to Facebook, which is another huge position of mine. Huge relative to my PA, not huge, relative to the amount of money in the world. Just have to make those disclaimers. But yeah, I'm comfortable holding Etsy. They have 4 brands there, and it's likely the Depop and ELO 7 less so, but it's likely that those two are going to kind of be accentuate the top line a little bit there. And inorganic growth is not always bad if they're not spending without the means. They kick off a lot of cash flow, Etsy. And I remember when I first started looking at them, I think it was late last year, and then I finally decided to buy some kind of in Q1, late Q1 or early Q2. They were kicking off a lot of cash flow, which surprised me, because when I first started looking at them, I thought, well, the stock prices went up loads during COVID. It's probably just another kind of stonk. And so it surprised me because they kick off a lot of free cash flow, they're profitable, and the kind of reinvestment runways are really strong there. And then the Depop acquisition and the ELO 7, they're kind of using some of that to some extent. So the inorganic growth is not terrible. Yeah, and I think the position weight, the weighting of the position kind of reflects my outlook on that. Do I think Etsy is going to be a $25 billion, $30 billion company in 5 years? I find that quite unlikely. And then as well, for me, actually, maybe conversely to most people, when I'm looking at making something my largest position, I'm not looking at what has the most potential upside. I'm really kind of looking at what do I feel has the kind of least or has the most downside protection. So when I was looking at Facebook trading at like $750 million, I don't think Facebook's going to 10 bag from, I think, November 2020 when I started buying it. I didn't think it was going to 10 bag from there over 5 years or 10 years, but I felt like it could reasonably, compound at a nice rate over the next 3 to 5 years without offering too much downside protection from that base of 750 million. So and also at that point, I had a lot of extended names and a lack of ideas. I felt like Facebook was a good ballast for the portfolio. So I just went guns blazing into that and made it an 18% position. It has diluted a little bit now. It's closer to 16. But that was the rationale behind that. And similar to Etsy, where I look at it today, and I think, what's the downside on this over the next 3 or 5 years? Management's already said they're going to be semi-aggressive pre these two acquisitions. They said they were going to be semi-aggressive with mergers and acquisitions. They already kick off a lot of cash flow. They have the ability to raise debt. They're not too indebted. So that's kind of how I look at having a larger position. Not really what's going to give me the most upside. It's really like what's going to protect me on the downside the most, and what do I feel most comfortable having the majority of my kind of, wealth held in over the medium term.
So that leads us quite nicely into one of the other companies on the list, and that's Match Group, which is also, because you released your portfolio today, didn't you? And was Match an 8% position? Have I remembered that right?
I think it was 8 or 7.
Yeah, so that's obviously another high conviction one. How do you feel about that? And also, I guess the valuation, because for me, it's a business where it's always been on my watch list. I've always really liked it. I've always thought it's a brilliant, brilliant product. I've just never pulled the trigger. It's always looked expensive to me. There have obviously been times where in hindsight it wasn't expensive, but I never pulled the trigger on any of those times. So.
Yeah, I always regret this one because when I think it was 2018, 2017, I think it was in 2017, maybe. But there was one of those 2 years where I bought Match Group and I sold it maybe 6 months later. And I think it was like somewhere between 50, 60, $70, that kind of range. This was obviously pre-spin-off. But yeah, still to this day, don't really understand why I sold it. I think I was just too infatuated with the 30% return that I'd received or something like that. Which seems ridiculous in hindsight, but I spoke about Match Group quite a lot at Chit Chat Money, so I won't like pour through the whole business. But the core thesis there is basically, I feel like the space is, everyone knows about it, but I don't feel like it's appreciated enough. Like Match Group are basically, like, not literally, but they have like a monopoly on the kind of online dating space. You have Bumble and you have all these other alternatives, and you also have the threat of people like Facebook. But I'm at the mind that people don't want to kind of mesh their social. Nobody wants to have their Instagram connected to their dating life or have their Facebook connected to their Facebook life. Facebook does have a dating, or they're experimenting with it across Europe and Canada and some parts of the US. And it's anonymous. It doesn't link to your Facebook, but nobody really wants to have those two things kind of being in the same place, or you're not in the frame of mind when you're scrolling through Facebook or Instagram as you are when you're scrolling through Tinder, unless you're just like a super thirsty human being. But I think that people are always, for the time being, going to look to the Bumbles and the Tinders and the Hinges and the Plenty of Fish to find dates. They're like separating that. And Match Group simply just have the best portfolio of assets in the market. Bumble has Badoo, which is interesting. I don't see the objection to owning both. I think both are going to do fairly well. But for me, I just feel like the portfolio of assets that Match Group has and, their ability to continue monetizing users is only going to grow. If you ask most people when I actually did research in this, so I used Tinder and Bumble for a short while, and then just asked people blatantly. I think I had my bio just a few questions, and I was like, which one do you prefer, Tinder or Bumble? Does Bumble make you feel empowered? And one of the questions was, have you ever paid to use, ancillary services of Tinder and Bumble? And most people said no. And most people, it was kind of like no, I wouldn't do that. That's gross. So I think, you could look at that badly.
Lied.
Yeah. I mean, it's not something that you want to admit, is it? It's not like, oh yeah, I paid to find a match. Like, yeah, look, I don't know if it's different between women and girls. I wasn't talking to any guys, but I know a few guys that use it and they pay for it and they're a lot more open about it. And it's just, I think that culture and that kind of attitude is going to change because over the last 20 years, people have changed from, desktop dating, Match.com, all these old ones where you had to pay before you even got into the service and use it. Whereas now you have freemium models like Tinder where you can, swipe left and right, but they gradually make the free product slightly, I wouldn't say worse.
Restrictive, maybe.
Yeah, restrictive, because you run out of likes. And just a number of guys and girls, they're out on a night out and maybe they've had a few drinks and they run out of likes and they'll just, willingly pay with Apple Pay and just, £15 so they can swipe for more, like that kind of thing. Like, so I think we came from desktop to mobile. And now it's kind of socially acceptable that people use Tinder and, find mates that way. It's still even taboo when I was younger and I was using it. I was 19, but everyone used to use it at university, but nobody would be like, oh, I met this girl on Tinder and we're dating now. But now I feel like that's way more socially acceptable. And, people get married from Tinder and Bumble. But the payment thing is the next one. So, when you go onto Tinder, it's free. That's all well and good. You get spammed with ads and all that kind of stuff. So, if you pay a small amount, you can get rid of those ads and you get, certain services. And then they obviously have Platinum as well, which I think they're expecting about 1 million people to be using by the end of the year. And that's, in the UK, it's £20. I don't know what that is in the US, whether it's $20 or slightly more. But I feel like the payment thing is the next thing to go. And if you look on Bumble as well, they're right on it. If you go on Bumble, it's actually more annoying not to pay using Bumble. And then if you look on Hinge is slightly different. So Hinge is focused on finding a long-term mate, whereas Tinder is focused on finding anything, they'll respond to you. But Hinge is slightly more expensive, but the experience is a lot better. So on Hinge, if you're really looking for something serious, you have to upload a minimum of 8 profile photos. You have to fill out a bunch of, I wouldn't say forms, but you have to like write things about yourself and
Just to make an effort with it.
Yeah, you have to spend about 15 or 20 minutes, sharing a bit about yourself before you can even finish updating your profile and start matching with people. But on the other side of that, when you're looking at potential partners, you have so much more information about them other than just looking at a picture of their face and not even bothering to look at the second one and swiping left or right. So they're totally different marketplaces. And within the Match Group portfolio, you have all these different brands that are targeted at different age groups, different ethnicities, different kind of cultures. And within Bumble, you just have Bumble, which is supposedly empowering to women. Most of the women I asked didn't really care about that aspect. They just, they see it as like a second marketplace to find potential other women or men to date. And the Badoo one, it just feels cheap and crummy. I don't know if they're going to invest in that, but that's bigger in Europe. But yeah, I just think with the Match portfolio, it's so much better. And, Tinder is kind of like a verb, like everyone knows what that is around the world. And then with the Tinder, brand is big, of course, but then Match Group are kind of also leaning into social discovery a bit more from what they found when they went to Asia, with the way that the culture is there. People aren't as, how do I put it, without offending anyone, a bit more reserved, not as kind of blasé as maybe an American or the UK. And it's a bit more taboo in places like Japan and, Singapore and all this kind of stuff, where people didn't want to be seen as using a dating app, but Tinder was actually marketed kind of, this is a place where you can find friends and colleagues and, connections, not really dating. And they also picked up those Hyperconnect assets a few quarters ago, which is really interesting because they have a range of different stuff. They have some enterprise kind of assets there, which was interesting, but then they have these 2 social discovery apps. And within those, they picked up Azar and Hakuna, and they're both, Azar is this kind of, you swipe left and right, but you're really having discussions with people. So you can go around the world and swipe and you'll find a guy or a girl in Spain and you'll just chat to them. It's it's making friends. It's not really with the emphasis on dating, although people do that on the app, but it's not really like the whole emphasis of it like it is on Tinder. So Azar is really big. I think it has, the numbers escape me, but it's big in Asia. And then Hakuna is really quite small. And it's a similar thing. It's kind of like live. It's almost like a constant stream of Instagram live videos and people jump in and communicate and stuff. But one of the differences with those 2 apps is you'll find kind of, if you look at Tinder, maybe 20% of the purchases are a la carte. So, and then the rest of it is all subscription based on the Tinder app. Whereas if you look on Azar, where the main demographic is in Asia, you'll find that close to 80% of the purchases are a la carte and 20% are subscription. And a lot of that's through kind of like in-app currency and little tokens and gifts that you can send people. So the consumption behavior between those 2 demographics is that. And, in Asia, people aren't so willing to, kind of subscribe to something on a recurring basis to use it. They would rather just spend freely if and when they want to. Whereas in the UK, we don't mind. And the kind of a la carte purchasing is, not something we're more so inclined to do. I know I'm rambling a bit here, but basically when you look at Match Group versus Bumble, if you are Match Group, it's just, they're in so many more, they're kind of doing more things and there's a lot more reinvestment runways there. The Azar and Hakuna assets could use a lot of, reinvestment or even just kind of the shared learnings there. Whereas Bumble for me right now is still kind of basically purely dating based, whereas the Match Group portfolio is obviously has its roots in dating and now it's kind of moving more into social discovery. On valuation, I definitely paid too much for it and that was a mistake. I think I said that on the last time I was here, but I definitely paid too much for it and went in too fast. Something to learn for future. I'd probably scale into it a bit more. That's another one where I look at the business and I think, what are they trailing 12-month basis? Maybe 4 billion, or they'll do 4 billion this year. Something, I think I had it down because I've not looked at Match for a couple of weeks, but I think I had it down that by the end of this year, they should surpass 4 billion in revenues. And they're trading at 50 billion. Do I think they're going to trade at 50 billion in X number of years? No. They might not generate such a great return over that time period based on the share price or the market valuation today, because obviously, your entry price kind of dictates what kind of return you're going to get there when you sell. But it's just it's a unique asset that I want to own, and I feel like I understand it pretty well. You said you didn't own any, did you?
No, I don't. I've always liked it though. It's always just seemed to me like what I look for in a business, obviously stock aside, it ticks pretty much every box, really. It's just such a great business. I think the only criticism you can really have of the business model is if it works well enough, a lot of people never come back. But there's always going to be like more people turning 18 and stuff. And I think what you were saying as well with like Match versus buying Bumble, I think one thing I always think is, and it's the comparison me and John have made a few times on the show, is Hargreaves Lansdown here in the UK, and we've compared that to AJ Bell, and I'm a shareholder of Hargreaves Lansdown. And AJ Bell's puts up good numbers, but Hargreaves Lansdown it's the better brand. Loads of people use it, and the Hargreaves Lansdown numbers for its size are extremely impressive. And I just think if you're going to go with number two, especially when it's a clear number two, it's not a close number two, I think you need a very, very good reason for doing it. And it can't just be it's smaller. And for me, if I look at Match v Bumble, if you look at the portfolio of brands, like you say, for me, like I'd be picking Match every day of the week.
Yeah, well, one thing Match Group do is when they see, when Hinge was kind of growing, they went and acquired it. When Pairs was growing, which was quite popular in Japan. It's an Asian-based dating site. When Pairs was growing, they went and acquired it, and they instantly got kind of a massive footprint in Japan from that, because it was the most popular dating platform. And now it's Pairs and Tinder. But right now, I don't really see any super impressive competitors out there that Bumble could go acquire. So they might have to develop something in-house. I really don't know. I like their brand. I like the CEO and kind of her story. I don't know too much about her, but I recently saw that they are opening a Bumble bar for an experiment for Bumble users to go and meet up. It reminded me of, you might know what this is, First Dates.
Yeah.
In the UK, where it's always based in the same restaurant and they come and they date and stuff like that. I think that's an interesting concept. It's quite novel. I don't really see what differentiates them. They say it's it's safety and it's somewhere you can recognize and all that kind of stuff. But I don't really see what the difference is from going to a Bumble bar or going to a Starbucks. Starbucks is they're not gonna let something weird happen in a Starbucks. Obviously, I have no idea. I've not been single for a number of years, so I don't really know what the dating culture is like.
See, I don't know much about Bumble bars, but it's instinctively I don't like the idea of it, especially when you're buying it for growth. And I think if it's going to start ploughing its money into opening up bars and restaurants, it's quite capital intensive, that business. And it's not really, if I was a Bumble shareholder, I'd sort of be looking at it and thinking, is that really the best use of capital?
Feels gimmicky.
Yeah.
It might be a good marketing stunt, but then it feels gimmicky.
If they've done it with the intention of doing one for the marketing, then fair enough, it's worked. But if they're going to start opening these all around the country, to me, it's just like, well, like you say, like when you look at their portfolio compared to Match's, I don't think their focus should be on opening bars. I think they need to focus on trying to like build the brand and acquire new brands and develop new brands if they have to.
And if you think, if you've got Bumble and then you've got millions of users using Bumble, you open a bar that can maybe seat 50 people, you're not really, the number of users that you're serving for that amount of kind of capital is, minimal. So I think it's probably just something, it's maybe experimental. It might be a marketing thing. They might have just leased it for a short term. I don't really know too much about it. It's interesting. If Match Group started doing that with Tinder, I don't like it'd be funny if it was an experiment, but if they started doing it, as part of their strategic kind of outlook, I don't think I'd be super happy as a shareholder.
They could do like blind dates, so like they put you down and like you've got a little screen in front of you and you swipe right or left. And if they swipe left, you've just got to get up and go. That'd be
that could be funny. Also,
it's quite cruel, but
yeah.
Anyway, the other company that people have asked about is CrowdStrike. I'll probably start this with a big fat disclaimer. It's a business I'm aware of. I know a lot of people like it on Twitter. For me, cybersecurity just goes straight in the too hard pile. So that's the extent of my knowledge. I know that you used to own it and you've sold it. So what are your thoughts on the business and I guess the sale as well?
So a few things, and I held it for about a year and it generated 185% in that space. So whilst like I sold it just under 200, now it trades maybe 250 a share. So obviously looks foolish in the short term. Most of that money went into Facebook to build that position there. So really kind of, I would have to check what they're both doing from the period that I kind of reinvested that. But I don't think the decision was terrible right now. But the decision at the time was, the way I look at circles of competency, not in kind of like a hard view, but kind of vaguely, is there's 3 circles. The smallest one is your kind of investing circle, which is stuff that you know really well and you're comfortable in, you know, investing in. If you're looking at a competitor in that space, you feel like you know the market well enough to really spend a couple of days on it and decide whether you like it or not, because you know all the competition, you know the market levers, you know all the forces and stuff like that. For me, that might be something like Starbucks. I feel comfortable in that space. You know, I could look at Dunkin' Donuts or Domino's, kind of, you know, have a kind of rough idea of where I am. And then a slightly bigger circle outside of that is maybe a learning circle, which is stuff that you might understand partially, but you might not understand the full extent of the kind of the levers in the market. And then the biggest circle is obviously stuff you just have no idea about. Oil, maybe energy for me, kind of stuff. But I feel like CrowdStrike was definitely in that kind of learning circle where I felt like I could understand the business. And it was a small position for me at the time. I think it was 2 to 3% when I first bought it. I understood the business. I liked the management. It was founder-led. They were growing fast. It looked like they were going to be able to start kicking off a lot of free cash flow. They did start actually kicking off free cash flow in a few of the quarters before I sold it. So I liked the business and I understood it. But when it came to the point where they started acquiring new companies like Humio and entering new spaces where they were kind of competing with people like Datadog, you know, the early signs there were like, oh, like it took me a lot of time to kind of catch up on that acquisition and understand like the full extent of what that means. And that kind of knowing what you don't know, like I always try to be aware of that, but that kind of just flagged that up for me and was like, I feel like I understand the business and all that kind of stuff, but the industry itself, I really don't understand whether the new competitive forces are going to come from there. I was aware of all the competitors and kind of what they do, but really, and when I started reading work of other people, it just made me realize that I really don't understand this industry as well as I need to have conviction. And obviously, from the point that I purchased it to the point that I sold it, it just kept going up. So that never really came into my mind. So I actually sold it before there was any real big drop in the share price. I don't mind doing that. I don't want to be caught at the point where it falls 40% and then I'm kind of testing my conviction. At that point, I realized that I wouldn't really have the conviction level to hold this through a 50% drawdown because I don't really understand the full extent of the kind of competitive nature of the industry. I just really like the business and understood the business, and at my previous place of work, we used it, and I spoke to a few of the engineers there, and they kind of took me through the process of using it and why they find it useful, so I could see why it was beneficial for kind of on an enterprise level. And we used CrowdStrike for a lot of stuff at my old place of work, and there's a lot of stuff going through that. So yeah, it was a case of me, I just don't feel like it was in my investing circle, it was just in my learning circle where it would be quite testing and challenging if, like, say a new competitor came in, or if someone made a sizable acquisition and it kind of impeded on CrowdStrike, or if there was a data breach, or I feel like the amount of time it would take me to catch up and understand that might outweigh the kind of the benefits of, holding through a downturn. I don't want to just be holding something because just out of dumb ignorance. Like, I'd rather know why I'm holding something through a downturn. And then, so that was part of it. I didn't want to be in a position where my conviction was tested when it was, riding down somewhere. That was maybe about a third of it. Secondly, the valuation, I just didn't really see. I struggled, and again, this is probably due to it not understanding the industry, but I just struggled to see where the upside would come over the next 3 or 5 years. Maybe I did think that it would maybe keep going up over the next year or two, but honestly, I just had no idea. I didn't know if it was going to be, I didn't know what the catalysts were to keep pulling it up, because obviously it'd been extended quite a lot already. It's just, I struggled to understand any of the catalysts there that were going to take it to that kind of next level. I didn't know if I'd just be waiting for the fundamentals to catch up, or if it would just keep, ripping. So I felt like there was better risk return elsewhere. And as I said, a lot of the proceeds there went into Facebook, which is now the largest. Yeah, I mean, it's done. Last time I looked, I think it's done equally as well from the point that I sold it as CrowdStrike over a 6-7 month period.
But you've
I'd have to
slept
double
better
check.
in that period as well.
Yeah, that's the thing, because Facebook fell to 600 million, I would be over the moon. I'd be buying more. If CrowdStrike cut in half, I feel like it's rich right now because it's a great company and it's growing so fast and all that kind of stuff. But then, price to perfection, it falls in half. It's not cheap when it falls in half. It's still reasonably expensive on the aggregate. But if Facebook was to fall 40-50% right now, I'd be buying boatloads of it because I feel like I understand the proposition better there. So yeah, it's kind of, and again, I might be totally wrong. I might look back in 3 or 5 years and say, wow, why did I sell CrowdStrike? But that's just part of the learning process. And, I just felt like I would be more comfortable with reallocating it somewhere where I felt the kind of risk reward over the medium term was slightly better. And some people might say, why don't you just hold it and then continue to kind of, pull that cybersecurity market into your kind of your investing circle and get to know it more over the next few years? You don't have to sell it. You could just let it sit there and let it naturally dilute as you continue adding cash flow into your PA. That's something I considered. But, as much as kind of economic theory likes to say, like all humans aren't rational, we all make mistakes. And it's going to be something that I'm going to come back to, in the next year, in the next 2 years, when I'm kind of going back over all the activity that I did in 2021 and 2020 and kind of reassessing where the mistakes were made and how I can change that in the future. So in short, I would say the kind of lack of understanding of the market, which led to kind of the risk of not having conviction if it was to fall significantly, also the valuation. And then lastly, I felt like there was better RR elsewhere, basically. It's still a great company. Still actually follow it and read the quarterly earnings and stuff like that as well.
For what it's worth, I think it sounds like you sold for the right reasons. And I can never remember who said it, but there's a quote where it's like, when investing, it's a trade-off basically between eating well and sleeping well. And if you're more comfortable with Facebook, I think even if it hadn't done as well in the same period, it's the right decision. It's not just based on what the stock does. Because I mean, you could have been 100% in Tesla a year ago, and that would have worked out really well, but you'd have had a lot of sleepless nights.
Oh yeah.
So that's the end of the company-specific questions. We did get a couple of general questions. So the first one is just intangible assets versus tangible assets. What do you prefer and why?
It really depends. And I think there's a case for having a bit of diversification there. And I don't know, do you like, can you leave links in your podcast?
I can do, yeah.
I'll send you this link so that your listeners can read it. But I recently read a good piece by Michael Mabusin, and it was about this whole idea between, tangible and intangible assets. It was a kind of short case study. And previous to reading that, I knew that the kind of, if you look at the indices, you'll see that over the last 100 years, the kind of aggregate level of tangible assets across all the biggest American companies is diminished. And the kind of the size of intangibles on the balance sheet is kind of blossomed, whereby now it's, I think, maybe 80 or 90% of total balance sheet value. And for me personally, I would say the majority of my PA is intangible. Then you have to consider, if you have an intangible asset, you can scale that much larger as you're increasing the user base of customers. But then with intangibles, you also have that kind of risk of the risk of kind of those assets becoming defunct and then worth a lot less. If you own some kind of hard capital asset and it's suddenly no longer in favor, there's still some kind of residual value there where you can sell it, unless it's super specialized. But there's always going to be some kind of residual value there. If you buy a house and, well, yeah, houses, people are always going to houses. But if you have some kind of physical asset, there's always going to be some recruitment there. Whereas if you have an intangible, say some new technology comes along the following day and completely renders it obsolete, then the value of that intangible just plummets and you're not going to get anything back on that. A great book for that is The Investor's Dilemma, and then the follow-up as well.
The Innovator's Dilemma, sorry.
Yeah, The Innovator's Dilemma. And that kind of talks about the changes in chip sizes over the years and, the incumbent struggles to kind of all that kind of stuff. That's tangible, obviously, but it's a similar kind of idea. And how do you put a value on tangible things? It's kind of hard. So the risk of obsolescence there is obviously a lot higher, but then the scalability is obviously a lot higher. Whereas on the tangible side, if, scaling it's harder because you need more capital put back into it, and it takes longer and all that kind of stuff. And just, you can't just send it around the world instantly. But then also the risk of obsolescence is slightly less. So that's something you have to consider. But yeah, nowadays, the majority of the kind of balance sheet value is based in intangibles, and I definitely say my portfolio reflects that. It's really interesting to just go look at something like Facebook, even if you don't want to own that. If you look at the balance sheet, it's just ridiculous. There's nothing in it. It's just cash and securities, and like, it's like, I know there is literally, there's Facebook's offices around the world, but it's like looking at an empty box and it's just got so much value in it. Whereas if you go look at something a bit more capital intensive, the balance sheet's got a lot more to it, and it's maybe not as populated with kind of tradable securities and cash and that kind of stuff. But yeah, it's personal preference, and I guess it really depends. But yeah, I'd say there's a case for having a bit of both in there, but really it just depends on industry and so many other factors, I think.
I think as well with intangible assets, you need to be so careful with them, because every single management team wants you to believe that they've got intangible assets. But then if you look at the best companies with intangible assets, I mean, the one that jumps out to me is Disney and their IP. I mean, that's, Netflix are spending 19 billion a year on content. They could do that for 10 years. I don't think their IP will be as good as Disney's. And that is just such a difficult, it's like Buffett says as well, or he always says with like Coca-Cola, you give him 100 billion budget and tell him to knock Coca-Cola off the perch. He doesn't know how he'd do it. But then you've got lots of other businesses that will try and tell you they've got intangible assets. It's like network effects. Everyone likes to say they've got network effects now. And I think you do need to be more careful with it. Whereas, with an oil company, at least, for example, like they do actually have all the oil in the ground and the wells and all that stuff. So you do need to be careful with it, I think.
If you're talking about even on the balance sheet or like more holistically, if you're like talking about something like Facebook, like this wouldn't happen, but if everyone just stopped using Facebook and Instagram and all this kind of stuff immediately tomorrow, then all the advertising revenues would dry up, and so it's hard to value that kind of thing. Yeah, it's an interesting topic. Thanks for the question.
So next one is, how do you spot companies with good unit economics?
Yeah, unit economics, it really depends on the company you're looking at. I spend a lot of time looking at kind of like, I was talking about Starbucks and Sushi, and that can be as simple as, if you're looking at how much it costs them to set up a new revenue generating unit, if it's a store, a franchise. As I referenced when I was talking about Sushi, it costs them less than 2 million to build a physical store and have a presence where they can start collecting revenue on customers. And then within, less than 2 years, they're kicking out about $3.5 million of sales each year from one of those stores on the aggregate. Once it kind of gets past 18 months and it's a bit more mature, it could be something as simple as that, where you're saying, well, that's a good payback period. If they're investing 2 million within that kind of period of time, they're getting that back plus extra, and they're getting extra brand exposure, and it's like free marketing and stuff like that. But yeah, I would say it differs depending on the industry and the kind of company, but really you just want to start getting a bit more forensic with the accounting. And it's not enough to look at one company and say, oh, there's good unit economics here, compared to some other company I know that does something completely different. You have to look at the competitor and try to find as close to a like for like comparison as you can, but which is obviously really difficult, because even though a bunch of companies are in the same kind of sector, typically the way that business runs is a lot different. But yeah, I would say just get forensic with the accounting and just kind of root around. And
yeah, I think the only thing I'd add is as well, like it's difficult, because if you do this, you'll find that you maybe end up with too much of a certain type of business. But if you think about like how much is like the marginal cost of an extra customer, like Netflix is a great example, and Disney as well with Disney Plus. But like for Netflix to add one subscriber, they don't really have any extra cost. Like the majority of it just goes straight to the bottom line. And the flip side is that if you do that, you're probably going to find that with a short amount of time, you're just going to end up with a portfolio full of subscriptions, companies and software as a service. But I think that's a good way to think about it. But you do need to be careful, because it's not the only definition. Because obviously, like McDonald's has fantastic unit economics, but there's a cost to every single extra customer. But it doesn't take away from how good those unit economics are.
Has to be viewed in the context of everything else, because you could look at Square and payments provider and see it costs them like $5 to acquire a new customer, whereas like a traditional bank might cost them thousands of dollars to acquire a new one customer, which on the face of it looks good. And that's probably why so many people are excited by, PayPal and Square and stuff like that. But then there's, it kind of has to be viewed a bit more, it's not a direct comparison. A bank is slightly different than what PayPal and Square are doing.
It's interesting as well, because those unit economics, they can also work the opposite way. Because where it's really, really easy for like a PayPal to gain customers, it means if it doesn't continue to like innovate and like stay on top of things, there's not a huge amount of cost for people to leave. I think PayPal's quite a good example because I really like PayPal. I've used it for years. And it's like my phone saved my password and stuff, but it wouldn't be that difficult for me to start using Cash App or something if I felt like PayPal was just a bit of a nightmare. So those unit economics can work against you as well as for you, I guess. The final question, and probably the most important one, and the one that everyone's been waiting for. Would you rather fight one horse-sized duck or 100 duck-sized horses?
I have been thinking about this I thought about it for maybe like 5-10 minutes today and came up with a good answer. I'd be interested first to hear your answer, and then I'm going to give my rationale.
So I would go for the horse-sized duck because I just think with 100 duck-sized horses, like if they all, assuming they're coherent and they're coordinated and they're working as a team, like, you know, you can like fight off 10 of them. And if the other 90 are on you, pecking you, you know, there's nothing you can really do. Whereas, you know, one duck-sized horse, one duck-sized horse would be the easiest actually, but one horse-sized duck, you know, it'd be tricky, but like you've got a chance, I reckon. What about you?
That's interesting. I went for the complete opposite. So I went with 100. Was it 100 duck-sized horses?
Yeah.
Yeah. So when I was thinking about one horse-sized duck, you know, ducks have that beak, and you know they can peck you and stuff like that. And I think a horse-sized duck would be quite difficult to, you know, I don't want to say kill. You know, that's the objective. But getting to that,
it's a fight to the death. This.
Yeah, it's going to be quite tough because as soon as you get close to that kind of exterior body, it's going to just peck you and potentially decapitate you. They don't have talons; they have flippers, I think, if I'm thinking about the right bird. But yeah, it's going to be quite difficult. It's going to be quite difficult to get close to that. Whereas if you have 100 duck-sized horses, you know, they have hooves, they could have teeth they could bite you with, but ducks are like maybe the height of your shin. And it'd be quite easy to kick a lot of them in unison, just run through a crowd of...
like death by 1,000 cuts, though, wouldn't it? If they're all just like having a nibble.
They could have a nibble, but I don't feel like horses are terribly violent, where ducks, when you get close to them, could be when you go behind a horse-sized horse, it could kick you. They're not terribly violent creatures, but with a duck, if you're to maybe I'm thinking too much of swans, but if you get too close to a duck that was the size of a horse, I feel like it'd be a much tougher fight.
I guess it'd be like if you could wring its neck, though, it's game over.
Yeah, but think about how thick that neck would be if it was the size.
You can't really. Yeah, it'd be tougher when it's a horse.
Yeah, so I would definitely say 100 duck-sized horses, because you could easily just kick them all out of existence within.
See, I don't think it would be that easy. I think if 100 of anything duck size attack you at the same time, you're just not be able to. You're going to get overpowered, aren't you? Just too many to deal with, I reckon. Whereas with the horse-sized duck, I mean, your odds still aren't great, but you know you can.
I think one day we'll be able to settle this in like virtual reality or something like that.
There's probably like a simulation already that exists. Yeah. It's trying to solve. Elon Musk's probably on it already, actually.
Yeah, no doubt.
Right, so I think that's the end then. So considerably shorter than last time, but hopefully just as valuable. Thank you again for coming on the show. Where can people go to find out more about you? And also, where can they find your deep dive? Because obviously the sushi deep dive we talked about is available for free.
So thanks for having me again. Love to come back on whenever you want. You can find me on Twitter, Investment Talk with 2Ks. All the links to everything, including the deep dive, will be kind of in my bio on the Investment Talk newsletter. And I'll be sure to send you a few of those links that I referred to today, so you can chuck them on the description of the episode and stuff like that.
Right. Okay. I think that's everything in that case. So thank you very much for joining us, and we'll see you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.